you so much for choosing to spend another few hours listening and learning with us. Of course, there are also those of you who this morning might be the first interaction you've had with Jim, our firm, and our virtual events. And for those of you who aren't familiar with Jim's credentials, I just want to assure you that Jim is an excellent resource for great information and cutting-edge retirement planning strategies. Jim has practical experience. He and our legal team have drafted 3,000 wills and trusts. Our accounting firm prepares 760 tax returns every year. And in conjunction with our money management partners, our RIA oversees over $900 million in assets under management. He's a nationally recognized IRA, Roth IRA, and 401k expert whose tax and estate planning strategies have been endorsed by the Wall Street Journal 36 times. He's been featured in Newsweek, Forbes, Reader's Digest, Bottom Line, and Kiplinger's, just to name a few. And he's a paid contributor at Forbes.com, and his peer-reviewed articles have appeared in Trust and Estates Magazine, Financial Planning, The Tax Advisor, and the Journal of Retirement Planning. He's the author of 8 best-selling books, including Retire Secure, which was endorsed by a number of financial luminaries from Larry King and Charles Schwab to Burton Malkiel and Ed Slott. As a member of the marketing team here at Lang, I've had the opportunity to get a unique behind-the-scenes look at just how much effort and energy Jim puts into presenting great information in these virtual events. And this particular content-heavy event is full of tax-savvy strategies for year-end and long-term planning that you'll be able to benefit from and apply whether you decide to work with us or not. So without further ado, please welcome Jim Lang.
Now, if the money is in a 401k, under IRS Notice 2014-54, issued when? 2014. That's why they call it IRS Notice 2014-something. You were able to take money directly from your 401k and go directly to a Roth IRA. Well, that's going to be eliminated. Typically at retirement, but not always. And basically, it is a method of separating the after-tax dollars and the pre-tax dollars inside the 401k and sending the pre-tax dollars to a traditional IRA, the after-tax dollars to a Roth IRA. Ed Slott calls this, in effect, separating the coffee from the cream because they've been mixed together. So this is nothing new, but what is new is the pending deadline. Okay, and by the way, you might think, oh, big deal, how much money is this really going to make? What difference is this going to be? And again, if you're going to cash it all out next year, it's not going to make much of a difference at all. If you live 20 years, will that make a difference? Yes, it will. But again, most of the people who we're working with, they're not going to spend their Roth IRA. I'm not saying you shouldn't, although typically if you have other monies to spend, it would be better if you spent other monies. But a lot of times this money is going to end up going to your heirs. So let's say that you die and you made this you've made these non-deductible Roth IRA conversions. Again, didn't cost you any money. Again, it could be hundreds of thousands of dollars, even on just a $50,000 after-tax dollars inside the IRA and the retirement plan. And frankly, we have a lot of clients who do have $50,000, some less, some actually quite a bit more. And there's some other proposed laws that I think some of the media people and some of the IRA experts are overhyping, but you should know about them and you should know about the impact of them. And who knows what the exact limits are going to be, but for high income, maybe roughly 400,000 and others, there's going to be a limit that says, hey, you're not going to be able to make Roth IRA conversions at all. Well, gee, so that might get people all flustered. Well, the good news is that at least right now, the effective date of that legislation is December 31, 2031. Again, so we would have 10 years to react to that if that law passes. I will say, though, that does add some urgency to doing more conversions and potentially starting those new conversions before year end. Okay, so I've done a little brief introduction. I'm going to go into some more, but this might be a good time to answer one or two questions. So Erica, do we have any questions either submitted ahead of time or in the live room?
Absolutely. We do have questions from the live room. We have a question from Sue I thought was interesting. So she says, Roth conversions can move money to the tax-free world. Another way to move money is to move stocks with capital gains to someone as a gift. Tax rates of cap gains versus ordinary income for Roth conversions. Where are the trade-offs and holes? So I guess she's asking you to compare those strategies.
Well, all right. So it's a good question. So one of the ways to avoid capital gains, particularly if you're in a high income tax bracket, is to gift that highly appreciated stock, typically to a child or a grandchild, but let's assume a child, and let's assume for the moment that that child is in a lower tax bracket than you are, and maybe that they're in the 15% bracket, which means their capital gains tax rate is 0. So let's say that you have an adult child who isn't making a lot of money, and you are interested in making a gift, taking some after-tax dollars that are highly appreciated, gifting that money to that child in a low tax bracket, having that child cash the money in. And guess what I want to do? I want, particularly since they're in a low tax bracket and they're not really giving up much by putting money in a Roth IRA, for them to put money in a Roth IRA, or if they're working in a Roth 401k or a Roth 403b. If you compare the difference between that example and just yourself doing a Roth IRA, and again, it's going to all depend on the situation, but that would be more effective because you're also, in addition to getting money from the taxable to the tax-free world, you're also getting money outside of your estate. Of course, again, I'm an attorney, I have to do a caveat, and you have to run the numbers. Each case is different, blah, blah, disclaimer, disclaimer, disclaimer. But I like gifting before Roth conversions if you think if you're sure you don't need the money. And one of the issues that we get is, well, gee, if I give the money to my kids, then I might not have money to pay the Roth for the Roth conversions. And again, that's accurate. Whether that's the best strategy, again, is going to depend on each situation. For the facts presented in the question, I like gifting better than Roth IRA conversions. And by the way, I should mention something. So we don't control our reputations. You control our reputations. And I have this reputation. Oh, Jim Lang, he's a Roth IRA guy. He's going to try to talk you into a big Roth IRA. He's going to just tell you how wonderful Roth IRA conversions are. And if you don't like Roth IRA conversions, don't listen to him because that's all he's about. And I admit that I do have that reputation, at least to some of the people in the marketplace. Let me tell you the reputation that I would prefer. Jim Lang and his team are very quantitative, and they like to run the numbers, and they like to come up with these financial master plans. And as a result of running the numbers and coming up with the financial master plan, they very often recommend a series of Roth IRA conversions based on tax bracket and individual situations. That is what I would prefer. So that last question was a perfect example when I would say, well, if you can only do one or the other, by the way, the real answer is probably to do both, but if you can only do one or the other, a lot of times gifting highly appreciated assets to somebody, typically a child, an adult child, to them, having them cash it out with no capital gains, having them take some of the money and contributing to their own Roth IRAs, to their own Roth 401ks is going to work better. So why don't we take one more and then we will move on, okay?
So this is actually the first question. Actually, you'll love this, Jim. The first thing that we had in the chat when I was doing the tech check was actually a question from Sarah. And she asked about Roth IRA conversions. She said, if you're converting from an IRA to a Roth IRA and on Medicare, what is the top of your income you want to be without having to pay IRMA or income related monthly adjustment amount? Do you have to pay IRMA before the standard deductions or after?
Well, I'm going to give a general answer that will apply to everybody because it's a very good question. And rather than being very specific, I'd rather give a more general answer, because if you understand the concepts, it's much easier to apply to your particular situation. So, and again, since I'm an attorney, I'm allowed to take one question and answer another question. But here's the question I want to answer that I think will actually do a better job of answering the specific question. What is the impact of doing a Roth IRA conversion, which adds to your taxable income, that could easily have an impact on your Medicare Part B premium? Now, again, I live and work in Pittsburgh, which is the home of Westinghouse, and Westinghouse has a group of retirees known as the Shore Group. And for over 20 years, every year, I give a presentation to the Shore Group, and I have quite a few of these, if you will, very smart retired engineers who tend to be very quantitative. And interestingly enough, they are very open to doing a series of Roth IRA conversions. It is almost a religion among that group to do a Roth IRA conversion up to, but not an amount that will increase their Medicare Part B. And Steve Coleman, who is, let's say, our primary number cruncher on Roth IRA conversions and is a true Roth IRA conversion expert, and the other people in our office have really gone through this extensively. I think we even have an article on it somewhere. But here's the upshot of it. Yes, you have to take that into consideration, but it is not totally determinative. And here, just for the people who like concepts instead of numbers, if you're doing a series of Roth IRA conversions, or maybe just one Roth IRA conversion that bumps your income into a higher bracket for Medicare Part B, maybe a higher bracket for taxes anyway, consider that money becomes a Roth IRA, which is no longer subject to minimum required distributions. So in the future, that money that would have been subject to minimum required distributions will no longer be considered income for the purposes of Medicare Part B. And actually, your Medicare Part B premium can go down. So again, does that mean you should ignore it? Absolutely not. You certainly have to take that into consideration. When we run the numbers, we always do. But I will tell you, you're very likely to be limiting yourself and coming up with a less than ideal Roth IRA conversion amount. If you make the determination, I'm not going to pay 1 cent extra for Medicare Part B. Again, it's easy for me to say because we have the ability to, let's say, run the numbers, quantify it, and then we typically we both look at, let's say, the results using a series of likely assumptions during your lifetime, and then we actually sometimes project it for at least another 10 years, which is how long you can keep the Roth IRA around after you die. And a lot of times we've come to the conclusion that yes, it does make some sense to incur some at least short-term Medicare Part B additional premiums. Okay? All right, so, and my clicker's not working again. I'm sorry, we're having some technical issues today. And I am not moving ahead. All right, there we are. It's delayed. All right, so I wanted to talk about the Secure Act a little bit because it does have a, let's say, an impact for Roth IRA conversions. So the Secure Act, and most of you know this, but perhaps some of you don't, basically says that after you die, your IRA, 401k, 403b, SEP, KEO, etc., unless it meets one of the exceptions, has to be withdrawn by your beneficiary and paid tax on within 10 years of your death. That was the law that I anticipated, and it's pure misery for IRA owners. If I was the government and I thought, well, how can I don't want to use the word screw, but I will anyway. How can I really screw people who we have been telling all along, hey, put money in your IRA, put money in your 401k. We're going to give you a deduction now. We're going to let the money grow income tax deferred. And then we're going to have you take it out, presumably when you're in a lower tax bracket. By the way, that didn't happen. A lot of my clients are in a higher tax bracket in retirement than when they were working. And we're going to give your heirs really favorable tax treatment. Well, guess what? We decided to change our minds. Even though you were relying on what we were telling you, and you maxed out your retirement plans. And now for a lot of you, 10, 20, 30 years later, you have all this money in IRAs and retirement plans thinking that your heirs would be able to stretch or defer income taxes, at least to some extent, for their whole lives. No, we changed our mind. They're going to have to take all the money out and pay taxes on it for 10 years. And you might be thinking, well, gee, big deal. Is it really, what is the true impact? Well, here's the true impact. Let's say for discussion's sake, you die with $1 million in your IRA and you leave it to your child, and given certain reasonable assumptions about spending, tax rates at blah, 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 blah. Under the old law, which is represented in the solid line here, your child, when they were 85 years old, would have $2 million. Under the Secure Act, with those same assumptions, and this is the law today, unless you meet one of the exceptions, your child would have nothing. Well, this has been scaring the bejeevers out of me for years, and we went to bat at it. And one of the things, it's nowhere near perfect, but one of the defenses against the Secure Act is to do a series of Roth IRA conversions. Now, we not only have the Secure Act to deal with, but we also have rising tax rates. Well, again, what is the, let's say, logical conclusion? I would say, again, Roth IRA conversions. All right, so when is the ideal time to convert? For years, I've been saying, let's say you're in your 60s, your income is way up here, you're at the peak of your earning capacity. That's not the best time to convert. Then you retire. So you don't, and let's say you're less than 72 years old, you don't have your income from your job or your self-employment, your income went from here way down to here. All right, in that case, you're in a low tax bracket. And then what's going to happen later? Well, at 70, by the way, not 66, but 70 for most people, you're going to have and if you're married, maybe depending on your spouse's age, you're going to have Social Security, maybe 2 Social Securities. And then when you're 72, you're going to have your minimum required distribution from your IRA. So guess what? Your income goes back up here. The ideal time to convert is down here, okay? But with the tax rates rising, with the Secure Act, when we are running numbers, we are finding that Roth IRA conversions often still are beneficial, even if you're working. And another group of people that it's more beneficial now than it was people over 72 who are already taking their required minimum distributions. And by the way, sometimes, well, most people, I hate to say this, but most people are not in planning mode, where 20 years ago they started doing appropriate planning and they got everything just right and everything was part of a great master plan, and they're just moving along. Most people, when it really comes down to it, where you are is the result of a bunch of individual decisions, each one that seemed to make sense at the time. Let's say you got married and you said, oh, gee, it's time to, maybe you had a child or two, gee, it's time to do a will. And then you went to the benefits office and they gave you a recommendation for how to invest your money in your retirement plan. And then maybe you met a financial advisor later on and changed the investments. Maybe got some after-tax dollars and you, either on your own or with some help, you invested that money. Maybe at some point you got some life insurance. Maybe you started doing some Roth IRA conversions. But anyway, the point is that most of us are not really in planning mode. We are the result of a bunch of individual decisions, each one typically done independently, that made sense at the time, and that is how we got to where we are. One of the things that we like to do is, however you got here, say, okay, what's the thing to do now? And very frankly, we not only see clients who should have been more aggressive with Roth IRA conversions, we also see clients that were overly aggressive with Roth IRA conversions. I was just looking at a client situation, and he had done most of his conversions while he was working in a high tax bracket. And yes, it was good that he got them in early, but if he was paying 24, 33% on the conversions, and then he has a bunch of years between retirement and 72, he would have been better off making either no or much smaller conversions. So again, we are the result of all these decisions that we were made. What we like to do is, however you got here, say, okay, what is the right thing to do? And I will tell you, with all the planning things, people tend to concentrate on which stock and which mutual fund and et cetera, et cetera, et cetera. Things that, frankly, we don't have much control over. We do have control with Roth IRA conversions. And the one thing that, the other thing that I will mention while we're on this, let's say, topic, is, and I'm talking globally now, is we used to say, okay, Roth IRA conversions are really cool because, you know, our kids and our grandkids were going to be able to stretch this thing for 20, 30, 50, 70 years. And I would call it offense. And that's what we were doing. Now, with the Secure Act and rising tax rates, even though it is a similar result, I would call it, we're now playing defense. So before we were trying to get maximum rip out of it. And again, a series of Roth conversions were usually the appropriate thing. Now it's, if you don't do a Roth, you and your heirs can really get nailed with the impending tax increases and the Secure Act.